Alright, class, let's begin the new chapter on cash flow estimation risk analysis. Alright, this is the continuation from the previous chapter 9 and 10. Right, so in chapter 9 and on the cash flow budgeting, we already learned the important techniques that we need to compute the capital budgeting uh, decisions. Alright. For example, NPV, IRR, MIRR, and so on. So in this chapter, we're going to first estimate the cash flow, alright, for a project, and then we will be starting to make the calculation, alright. So what are the things we're going to learn in this chapter would be relevant cash flows, alright. What are the relevant cash flows? Because there could be irrelevant things are cash flows that is not necessary, you should not be including in the budget. And then things that we have to incorporate, such as inflation, then the types of risk and some risk analysis. Alright, so let's start with the cash flow estimation. Alright, the question would be why we need to make an estimation, right? So the reason is it is important, right? Important. So important for a project valuation. Okay, so if you want to evaluate whether we want to undertake the new project or not, first we need to estimate the cash flow. Alright, before even starting to do NPV, IRR, the fundamental thing that you require is the cash flow estimation. If let's say for the next 5 years you have a project, you have to forecast what would be the cash flow that you're going to receive and also to pay. So that is the estimation. So if your estimation is wrong, obviously your calculation of NPV or IRR would be definitely wrong. So this is important to have as much as possible, alright, accurate estimation. So importance of project valuation, because it affects the company's valuation. And then relevance, we're going to talk about relevance of cash flow over accounting income. Alright, and then you have incremental cash flow basis. Alright, so class, there is a difference between accounting income and cash flow. You would have heard that before. If I say accounting, the profit for a company is 2 million, and if I ask, do they really have cash worth 2 million, then the answer is no. Alright, accounting income is merely estimation. Alright, cash flow is the real cash you hold. Alright, and then you have incremental cash flow basis. Incremental means if you do a new project, whatever cash flow that you need that is relevant for the new project is what you call as incremental cash flow. Alright, you don't include whatever existing cash flow in a project. Alright, you have an existing company, alright, and then now you're trying to do a new project. So when you're doing a new project, you should only include the projects, that particular project's relevant cash flow, whether you make a payment or receiving payment, only that you will include. So that is why it's called incremental cash flow basis. So business applications would be determine the value based on accurate cash flow projection. So as I said, if your projection is inaccurate, then obviously your value that derived from that calculation will be wrong as well. Alright, so there are projects. So we're going to find what are the types of projects there. Alright, so there would be new projects or a project that you're basically replacing. Alright, like a replacing machinery. Existing operation, you only want to replace the machinery. Alright, so again, we're going to talk about what is relevant cash flows. Alright, anything specific for that particular project that is relevant. Alright, other than that, it becomes irrelevant. Then you have depreciation and tax effects. So all this will be, we will be calculating in our cash flow. And then inflation also risk. Alright, all this will be included in our cash flow calculation. Alright, moving on. So what is the capital budgeting analysis? What long-term projects should our company undertake in order to generate additional value to the shareholders? Alright, so the key point is what? Long-term. We are not looking at the short-term. Short-term is working capital. Alright, so this is long-term projects. So it is related to non-current assets. Alright, buying machineries, buying a new company, alright, expanding your products, alright, to generate additional return. Alright, so you want to give more value to the shareholders. Alright, and then again, here's emphasized cash flows are key, not accounting income. As I mentioned, accounting income can be estimation, right? It is a profit is basically accounting estimation, but cash flow are not estimation, right? So cash flow is the key for this particular chapter. We will be using cash flows. All right, so let's move to the next slide. Consider only incremental cash flows. Compare outflows to acquire versus inflows generated by operating projects. So again, we're only talking about that particular project. Whether it is outflow, alright, you need to buy certain assets, or you want to make some payment, that's outflow. And then inflows, by doing a project, you earn money, income, right? So that is inflow. So present value of inflows more than present value of outflows, then you are making money or you're adding value to the company. Inflows more than outflows, right? Except if project generates positive NPV. So we learned this in the previous chapter. When your NPV you calculate, you get positive, you accept. Negative means you reject. So incremental cash flow for a project would be cash flow, alright, for the project minus cash flow without the project. See, for example, currently your current existing business, alright, for the current existing business, the cash flow is 50 million, alright, so that is the cash flow you're getting for current business. Let's say you are doing a new business, alright, new project. Currently your cash flow is 50 million. With the new project, now your cash flow is 70 million. Alright, so previously the existing business only 50 million. Now with the new project, alright, existing plus the new projects, your cash flow is 70 million. So incremental cash flow is corporate cash flow with the project, which is 70 million, minus without the project, which is the existing business 50 million. So 70 minus 50 is 20 million. That is your incremental cash flow. Alright, so throughout this chapter, we only want to know how much cash flow is affecting the new project, not the existing project. We are not interested in the existing project. What is the new projects? How is going to be relevant? for the calculation, how is it going to be profitable. So that is our key idea. Alright, so let's move on to the next slide where we're going to learn about types of costs. And these types of costs will give you an idea whether it is going to be relevant for the case study or the project or irrelevant. Because relevant means you have to take into calculation, irrelevant means you just remove or ignore it. Alright, so let's start with the first one. The first one would be sunk costs. Alright, sunk costs is an irrelevant cost. Alright, sunk means, alright, for example, Titanic. It's one of the most exclusive, most expensive cruise ship at the time it was built. But once it met with the with the iceberg, it's the story, right? Once it hit the iceberg, it sinks. All right, the entire cruise ship sinks. So what happened? It could be 100 million worth of a cruise. Once it's downed at the bottom of the ocean, it becomes worthless. Alright, so that means sunk cost. Sunk cost means it's no longer relevant. Alright, for instance, if you do for projects, case studies, we usually have research and development costs. See, research and development cost is irrelevant, sunk cost. Why? Whether you're going to do the new project or not, you already spent money on research and R&D. So whether you're going to do the new project or not, it's not going to make a difference. That is why it is irrelevant. So you need to identify certain items, whether it's sunk cost, whether it's incremental, and so on. Then you choose whether you're going to keep it or remove it. And the next one would be incremental cost. As we discussed earlier, incremental cost means what are the cash flows that is coming from undertaking a new project. Like I said, existing plus new project was 70 million minus the existing, remaining is 20 million, right? So that is the incremental cost. So that's the cost that is affecting the new project. That is incremental. So remember, additional from existing, whatever additional cost incurred for the new project, that is what is incremental. Okay. And then you have externalities. Externalities means the cost that affects other projects by accepting new. Alright, externalities means affects other project by accepting new. Alright, for instance, okay, let's take a company that sells only oranges. Alright, let's say they only selling oranges, and then later on they're coming out with apple juice. Alright, what will happen? Now the customers have a choice. Instead of just orange juice, they might just choose the apple juice. Right? So what will happen? By accepting the new one, you are leaving out the old items. So that is called externalities. By doing a new project, it might affect the other business. Alright? So that is externalities. Affect other project by accepting new. Then you have opportunity costs. Alright, so class, you can write down there. Opportunity cost means loss of potential gain from other alternatives, you choose it. Alright, repeat. Loss of potential gain from other alternatives you have chosen. Right, for example, you have a piece of land. Alright, you can sell the piece of land for 2 million. So that is one option. Or you can keep the land and use it to build a new factory. Alright, so that is opportunity cost. If you don't sell the land for 2 million and end up using the land to build a factory, you lose the 2 million. That is opportunity cost. Alright. And then you have shipping and installation. That's quite straightforward, right? So if you want if you're buying a product, an asset, a machinery from overseas, you need to pay for the shipping and installation. So that is relevant. Alright. So class, incremental cost is relevant, externalities is also relevant, opportunity cost is also relevant, right? As well as the shipping and installation. And the last one, finance, not the last one, second last. Your financing cost is the interest you pay from borrowing. Alright, the interest you pay from borrowing, is it relevant? No, it is irrelevant. And the reason why it's irrelevant, because later on we will be using cost of capital as the discount rate. Remember, in NPV we use discount rate, alright, to calculate the present value. From cash flow to convert to present value, we use discount rate. Therefore, financing is already applicable there. Alright, so you no longer have to calculate the financing cost. And the last one, taxes, is it relevant? Yes, of course, relevant. So we will be minusing taxes, tax later. Alright, so now next on we're going to be explaining to you the whole cash flow calculation based on a case study. Alright, I've included a case study. It's called Applied Food Products. Alright, so class, you have to read. Maybe I give you a couple of minutes. Go ahead, read and understand the case study, because we will be using this to end up a create complete cash flow, right? Class, you can actually pause the video and read the whole thing. Alright, then once you come back, so let's look into the important aspects here. So Allied Food Products, they want to expand their fruit juice business, right, with a new lemon juice product. So they hired a director to come out with evaluate the new project. So they're going to use produce from the unused building. Alright, so Allied owns the building which is fully depreciated. Alright, now the requirement, the equipment would cost 200,000. First, do you think it's relevant? Alright, you are starting a project, so definitely you need equipment to do that. So it's relevant, and this is your initial investment. Alright, because before you start the project, you need to have the equipment. So your initial investment 200,000 plus an additional 40,000 for shipping and installation. Again, we just um, learn about this, right? This type of cost, which is shipping and installation, it's also relevant. So the first year you'll be including 200,000 plus 40,000, not first year, year zero, beginning of the year. All right. In addition, inventories would rise by 25,000 while accounts payable would increase by 5,000, and all this incurred in year zero, beginning of the year. So yearly depreciation rate, the machinery is an asset, so we already given what is the rate it will depreciate, and 1 to 4. All right, therefore we can assume it's a 4 years project. All right, even as stated here, the project operates for 4 years. After that, it will be terminated. Beginning year 1. All right, starting year 1, year 4. The equipment will have a salvage value of 25,000. I don't know whether you've heard that before. Salvage value means you bought the projects at the beginning of the year, year zero, and you use it for the next 4 years. End of the 4th year, you can still dispose the asset at a value. Alright, so that is called salvage value. You would have heard scrap value or disposal value. Alright, so salvage value or disposal value is an asset you bought in the beginning of the project, and after use for the term of the project, if it still got some value, you dispose the asset, and the gain from disposal is called salvage value, right? So it's 25,000. So units expected to sell is 100,000 per year. Your selling price you expected is $2. Your operating cost is 60% of your sales. Your tax rate is 40%, and your WACC is 10%. That's your cost of capital. Alright, so and then some other information. So basically you're going to be filling up each of these items here, and then we'll, at the end of the day, we're going to find out what is the operating cash. Okay, this is the whole idea. That we very helpful. So let's see. Alight has a standard form that used in the capital budgeting process. So you must replace the blanks with the missing numbers. So complete the table using the following steps. So it's like a questionnaire. We're going to be doing one by one. So the first one, fill in the blanks under year zero for the initial investment outlay. All right. So you're going to fill up this portion here. Year zero means, so you see, you need to know what's the difference between year zero and year one. Year zero, year one means this is the beginning of the year, this is end of the year. Alright, so beginning of year one, end of year one. So this is end of year two, end of year three, end of year four. So beginning of the year means it's like 1st January 2020. This is 31st December 2020. Alright. So the first part you are asked to fill up here. So how much was the investment outlay? Alright. For this project, how much you have spent? What's the outlay? That's cash outflow, right? So let's look here. Alright, in the slides, of course, all the important items have stated here. Alright, including economic life, the depreciation rate, salvage value, tax rate, WACC, and so on. And they even stated here is, in order to calculate the cash flows, you have initial costs, your initial investment or initial outlay, followed by operating cash flow, year 1, year 2, year 3, year 4, and the end of year 4 you have terminal cash flow. So that's a salvage value. Right. So this is the basically a standard structure for a project. You have initial investment, usually outflow, followed by inflows, and then plus with another inflow. Terminal cash flow is salvage value, right? Gain from disposal of your asset. So this is the standard structure you'll have for cash flow budgeting. Alright, so this is the first year. You need to find your net working capital. Okay, before we go to that one, let's see here. So your equipment cost is, how much is your equipment cost? Equipment cost is 200,000 plus you have installation of 40,000. So you can start writing, filling up your the structure here. 200,000, then you have installation 40,000, then you have inventory. Okay, that is what we're gonna look here. You see, inventories, when it increase, all right, when your inventories increase, what happened? You're buying supplies, right? When you're buying supplies, you are investing money. All right, so that is cash outflow. Okay, and then you have another one, 5,000, which is your accounts payable. So 5,000 accounts payable is money that you owe to the suppliers. Is that an outflow, inflow? The money that you're owing to someone. So it is considered inflow because it's still, the money is still with you, right? So that is, if that increase, that is positive. If your inventories increase, that is negative. So 25,000 minus 5%, so your net working capital would be 20,000. All right. So in year 0, you have 200,000 cash outflow, 40,000 cash outflow, and the net working capital is also cash outflow. So total is 260,000. All right. So class, so negative 200,000, negative 40,000, negative 25,000. The only positive things is accounts payable. All right, so you fill out this. So in year 0, you would be having totally negative 260,000. So let's move on. We're done with the first part, part A. Then complete the table for unit sales, sales price, total revenues, and operating costs excluding depreciation. Alright, so you can calculate depreciation by, since in this case study they have already given you the annual depreciation, therefore 240 times 33, the year 1, 45, year 2, and so on. So this is your depreciation rate respectively, and then you can start calculating your operating cash flow. Alright, so let's look at the over here. Alright, so let's do one by one. So your unit sales is in thousands, right? So it's fixed. FD is 100,000, right? 100,000 units per year. So you, alright, state here 100. Then price per unit is 2. Your selling price is 2, so your total revenue is 200. All right, in thousands is 200,000, right? So your units you sell, units sold, price per unit, so you have total revenue. And then if you remember, your operating cost is 60% of your revenue, therefore 120,000, okay, for all 4 years. And then you have depreciation. Alright, so depreciation is what we have just computed as I showed in the slide. Alright, because 240 class, when you calculate depreciation, you have to include installation as well. Don't just calculate the given cost. You need to incur both of this. Alright, so times the percentage, you calculate this. That's your total cost. Alright, 120 plus 79, that's your total cost. So your operating income before taxes is revenue minus your total cost. So 200 minus 199.2, you get 0.8. Year 2, 200 minus 228,000, you get negative, right? What happened? Year 2, your cost is more than your revenue, therefore you have cash outflow here. Remaining year is still inflow, right? And then you have to pay tax, right? Income, then definitely you have to pay tax. It's 40%, 0.8 times 40%, you get 0.32. all right, so you're going to calculate the same thing for all of all the EBIT, yeah, 1 2 3 4. All right, so class, if you can see over here, 0.8 minus tax, you get 0.5. all right, so you can use as a that you are deducting the value. Is it negative? It's actually you get tax refund, right? Instead of you are paying tax, you are getting refund because you're making a loss one. So this is a refund. So 28 minus 11.2, your net loss is only 16.8, and 6.4, 37.9. Year 4, year 3 and 4, and then you have, all right, so depreciation. So this is an important part in your cash flow calculation. Okay. First, you have minus the depreciation, right? Because it's a cost. Yeah, minus. But here you have again added back the depreciation. All right, here you're using as a cost, but here you add back the depreciation. So this is the important point, and you need to know the reason why we have the minus, then we add back. And the reason is because depreciation is a non-cash item. There is no real cash. I'm not really paying 79,200 away. There's no real cash. Then what is 79,200? That is merely an accounting estimation. See, for example, I bought, let's say I buy a car worth 100,000 today. After 5 years, do you think the car still goes at the value of 100,000? No, right? Maybe it just the value might be only 20,000. From 100,000 it drops to 20,000. What happened to the 80,000? How are you going to estimate? How I'm going to account it? So that is why I calculate depreciation. Every year maybe I minus about 15,000 or 20,000, so that at the end of the fourth year or fifth year, I know the value would have been dropped. All right. So the depreciation, since is a non-cash item, we will minus here first and we add back. And the reason why we have to minus and add back is because of tax. So there is only one thing in between, if you see, which is your tax. We take the depreciation as a cost, therefore we minus from the sales, and then the profit we receive, we calculate tax first. Once you calculate tax, then you have to add back, because we're not calculating accounting profit. So you see, until here would be accounting profit. The time you add back, it becomes cash flow. Alright, so from here to here is usually our common way of calculating accounting profit. Revenue minus cost minus tax, right? You have your accounting. But here, since it's cash flow, we have to add back the depreciation, right? Of course, in income statement, you will have your financing costs also. Here we don't have financing costs, as I mentioned. Later we'll be using it to calculate your discount rate. So this is your project operating cash flow would be 79.7, 91.2, 62.4, and 54.7. Alright, so if you look over here, we have done with the unit sales, sales price, revenue. Alright, then we calculated depreciation, and we have also done with the tax calculation, right? And then now we look at terminal cash flow, right? Alright, so at the end of the year 4, when the project ends, the project completed, there are certain cash flows you will incur as well. Alright, so what is the cash flow? The first one, return on net working capital. If you remember in the beginning, 25 minus 5 is our investment on net working capital. At the end of the project, we will get back whatever we spend for working capital as well. So that is why initially you minus, then you add back. Alright, and then you have salvage value. Salvage value is the gain from disposal of asset. As you can see over here in our case study, it was stated as 25,000. So that is why you add 25,000. But here you have minus 10,000. What is that? Then the tax. Again, whatever revenue you get, you still need to pay tax, right? So tax on salvage value, 40% of 25, you get 10. Alright, so your total project termination cash flow will be 35. So in year 4 alone, you have two cash flows. One is operating. Alright, this whole process you call this operating cash flow, and this as a termination clause cash flow, which occurs at the end of the project. Alright, so now we want to calculate the project's net cash flow. Alright, this is the final cash flow. So year 0 is 260,000. Alright, so plus usually the first investment outlay, once you calculate, in between there won't be anything. Alright, so you can take the whole thing to 60, bring it at the bottom as your net cash flow. Then your operating cash flow 79.7, 91.2, 62.4, except for the Fourth year, you are required to add these two, operating cash flow and termination cash flow. All right. So you have the final cash flows. So this is basically the method to calculate the cash flow for a project. Alright, so it's important to understand the whole idea: investment, operating, and termination cash flow. See, once you calculate this part, then only we can move to the next part, which is to calculate NPV, IRR, MIR, and so on. In the previous chapter 9 and 10, already this portion, net cash flow, is already given. They never give you the whole thing. They never ask you to calculate. They've given you this, then they ask to calculate. They ask to calculate the NPV. But this time, we need to calculate from scratch.